Today, I'm going to share with you, as an investor, the most important things you need to know from the Q4 2025 Extra Space earnings call and what it means for the future of this industry. Welcome to the Self Storage Report. I'm your host, Chris Berg, head of business development here at Abernathy Holdings. So let's jump right in. If you're a business person, as you know, if your expenses are rising faster than your revenues, typically not great news for your business. And that's essentially what the CFO of Extra Space, Jeff Norman, had to say during the call.
In last night's earnings release, we provided our 2026 outlook. Our guidance reflects our current visibility and represents a slow and steady recovery in storage fundamentals. We have not assumed any specific catalysts that can materially accelerate storage demand or any material positive or negative changes in the economy. Specifically, we have not assumed a meaningful improvement in the housing market, nor a change to current pricing restrictions in Los Angeles County. With these factors in mind, our 2026 same-store revenue guidance is negative 0.5% to positive 1.5%. Our expense growth range is 2% to 3.5%, reflecting disciplined cost management while maintaining.
So there you go. You've got this lower, obviously, revenue marker with higher expenses. So really a surprise when you think about this industry. Now, one of the things that's really driving expenses they talk about within the phone call is, surprisingly enough, they talked about property taxes beginning to lower for themselves. They've done a good job mitigating that cost. But one of their bigger concerns is healthcare costs. So just something to keep your eye on. I've been hearing that from a lot of corporate executives as well, that healthcare costs have been somewhat of a surprise to them. I'm going to share with you here real quickly the stock chart for Extra Space, and then I'm going to play a clip from CEO Joe Margolis. It was a while back. We were talking about what's happening within the REITs and their stocks. And, you can see here, this is a 5-year chart, but it was pretty obvious to me, because when you're a CEO of a REIT, you get paid to allocate capital effectively, to maximize that, return on your capital. And there was a point where it was like, look, at some point it's going to make sense for Extra Space to buy back some stock. Well, they recently announced that in this earnings call. Here's what CEO Joe Margolis had to say. And just ask you to pay attention to the price that he talks about here, and I'll explain why in a moment.
We took advantage of an opportunity to repurchase approximately $141 million of our common shares at an average price of around $129.
So $141 million, average price of $129. Why is that important? You can see here on this chart, hopefully you can see it at least, but this is suggests right around 127 the price. So 129 puts you right along here at this bottom, where they obviously believe, based on their analysis, that, hey, we think this is probably the bottom of where our stock's going to be. We can come back here, buy back some stock, increase the value for our shareholders. And it's really been going up since. And again, this is a 5-year chart, but you can see it's just crossing over that 200-day moving average, which is typically a pretty important metric within a stock chart. So just something to keep your eye on here. I've been in a conversation now for quite some time suggesting, hey, keep your eye on the end of 2026. That's when I think the land markets are going to peak. If that's the case, does it have a negative impact on Extra Space's share price? I guess obviously only time will tell. I think one thing when you think about storage is sometimes it can almost be contrarian. So even if things go awry in the land market, within the economy, which we'll talk about more here later on in the show, sometimes that can actually bode well for storage, because people, unfortunately, there's more unemployment. They've got to store things. They're moving around. So we'll see how that bears out for the stock price. But I think it's really interesting. They actually pulled the trigger around 129 for an average price to buy back some stock. And obviously, Joe Margolis believes, hey, that's the best use of our capital at this particular time. One other thing that's been a really important conversation that I want to share with you is there's, as many of you know, because we talked about it a lot here on the Self Storage Report, in regards to California SB 709, what kind of impact, if at all, that was going to play. There was a lot of uproar around how this new disclosure bill within self-storage could have a big impact potentially on rates, on the value of assets. The people at California Self-Storage did a phenomenal job going up to Sacramento and lobbying, trying to change rather than a cap on rents, to make it more of a disclosure. I think what's intriguing, what you're going to hear here from Joe Margolis, as he was asked about, is it really hasn't had any impact on their rents, their rates whatsoever. So here's what he had to say.
So our disclosure legislation was as robust as what they're requiring. Now, they wanted it in a different spot in the lease in a specific font and color. None of that made any difference. We had very robust disclosure before the bill, and now everybody has the similar disclosure, kind of more of a level playing field. And we haven't seen any effect on our leasing activity in California.
So really important to note there, because again, there was a lot of conversation on how this was going to impact leasing activity, rents, and up to this point, at least, I know it's early. We're only in February. This started in early January, but at this point, there's that zero impact, at least for Extra Space. Another piece of the conversation that takes place here, and this is an analyst asking about this, but we've been talking a lot as of late here on the show in regards to demand and what drives demand within self-storage. You can't really manufacture demand. It's not like I can say, oh, hey, look, we've got now self-storage version, 17.0, like they can for a new iPhone or whatnot. So you can't really manufacture demand when it comes to storage, but there are key drivers. And some of those obviously are movement. You've got job growth. And so Joe Margolis was asked about that. Here's what he had to say.
Awesome. That's great to hear. And I guess a slight pivot here as a follow-up, but you guys mentioned that the guidance is not factoring in any, housing market recovery or any improvements in the macroeconomic environment. But I guess more broadly speaking, what are like the top, macroeconomic drivers outside of home sales that you guys view could help provide a catalyst for the storage industry? Are you guys tracking anything specific, both on a market or national level? Any color here would be super helpful.
So a couple factors that we think are very important. One is job growth. I think job growth is highly correlated to self-storage performance. And it's one of the reasons that even though in 2025, our exposure to Sunbelt markets was a headwind, that we believe our kind of proportional overexposure compared to our peers to the Sunbelt is going to be a benefit to us.
So we'll see how that plays out. I apologize for some of the audio here. There was some feedback, obviously, on the conference call. And I wanted to pause here for a moment because when you think about the bigger picture right now, as far as job growth, it's clearly been slowing within the economy. If you look at recent college grads, the unemployment rate in that demographic is just abysmal right now. And then you start to layer on the impact of what's happening with AI and the big conversation in regards to all these white collar jobs being wiped out because of AI. We'll see if that thesis bears out to be true or not. Point being, though, is that if job growth is a huge driver of self-storage demand, and that people are laying in more and more AI, we've seen more and more layoffs within even tech companies. Where is that robust job growth going to happen? Is it going to be in robotics, which might be in Austin with Tesla and Optimus? We don't know at this point, but I think it's something you want to be aware of, if knowing that, hey, one of the demand drivers obviously is housing movement, which has been completely stagnant. We talked about that in the last show. And then he says job growth, which is not growing as robustly as we probably think it should be, especially when you start to layer in the conversation around AI. So the demand factor is right now definitely a headwind for self-storage. You just want to keep your eye on that as you're beginning to look at sites that you either want to invest in, acquire, and or develop.
In the future, we do believe that's where there'll be outsized job growth. And then the other most important factor is, of course, supply. And we see, not that supply is going to zero. I don't think it will ever go to zero, new supply, but we do see a continued incremental reduction in new stores getting delivered.
So I'm going to pause it there. I'm going to go into another clip in regards to supply, because it was addressed more specifically, and it was asked about specifically for the CEO, Joe Margolis, and what he said about supply. I'm going to continue to say in this business, because I'm a simple guy, simple good, complex bad, that this business, this industry, your assets are really determined by supply and demand. And that's why we want to talk a lot here on the show about building responsibly. Many people, I think, got in the early 2020s and were like, hey, piece of dirt, I can just throw some steel up, make some money. That's not is what's happening today. And so I never want to discourage somebody from building, but if you are going to go out and build and develop, I would just really encourage you to make sure that you understand the demand metrics in this industry and what's happening from a supply perspective before you just start plopping down more steel and realize, like, oh my gosh, all my equity just got wiped out. Now what am I going to do? So here's a question in regards specifically to supply and how Joe Margolis, the CEO of Extra Space, responds.
stores getting built. So wondering if you can give more details on your supply expectations, which markets are more versus less exposed, and also which data source informs that view.
So we start with Yardi, which is a national database and might have a little different opinion. We take that data and we apply it, only to the markets that we're active in, right? So we don't care what's getting built in North Dakota, for example. And then we use other data that we have through our people on the ground, our investments team, our management team. And when we look at that, stores that we expect to be delivered in 2026 in our same store markets, it's a incremental step down, very modest step down, but a step down. I'd also say that when you look, Yardi does a great job. We think they're the best data source in the industry. I'm not criticizing Yardi, but I think it's hard for them when projects get canceled for them to take it off of their list. They're sometimes behind on taking stores off their list that don't go forward.
So this is a big conversation right now in the industry because I think many metrics are saying that, hey, supply is going down. I think many people would even concur with that, although there was a gentleman from Andover at the New York SSA where he talked about, look, if rates were to turn, meaning interest rates, or if rental rates would start to go back up, he believes that there's a lot of quote unquote dormant supply that isn't necessarily on the books, or maybe was in being proposed or in planning a long time ago, has been just sitting there now. He's like, hey, if things turn in this industry, you could see some of that supply come back online very, very quickly. In fact, Yardi just recently reassessed the supply and actually said it was going back up, or at least in that direction. So just again, one thing you want to keep your eye on: what's the demand in a market and what's the supply coming online. And sometimes you want to look at a Yardi or some of the different software or information that's out there, but always go and talk to the city specifically and say, hey, what's in the pipeline? What do you guys have going on right now as far as self-storage assets that are being built or potentially being built, just so you've got really clear specifics on what potentially could be coming into that market. I want to share this last clip with you. It's really interesting and important in my opinion, because if you look at Extra Space versus Public Storage, like these are the two giants that are battling out in the self-storage REIT space. And what's fascinating, if you listen to both the earnings calls, and we'll do an analysis on Public Storage in the next week or so, but they're really leaning into their data. They're really leaning into how do we, leverage data and AI to really help lower headcount and just maximize efficiencies, where Extra Space is a huge proponent of having on-site managers, more of a headcount, live bodies. And Joe Margolis was asked about that, especially in the context of, hey, you just said earlier in your guidance that your expenses are rising. What can you be doing to maybe cut some expenses? And so here's how Joe Margolis responds to the question around having in live people inside their stores. And I think he makes a very strong argument.
So our philosophy is that we want to let the customer choose how to do business with us. And the customer can't choose how to do business with us if we close certain channels to them. So right now, we allow the customer to interact with us online, at the call center, or at the store. And 31% of our leases are from customers who walk into the store and have not interacted with us online or on the phone.
So just let that sink for a moment. It's almost a third, 31% of their customers. Now, a couple of questions. One, how do they know that this person has never interacted with them online or on their phone? So that's a little bit freakish, but 31%, if that data point is accurate, almost a third of their customers have never had any sort of contact with them in a digital fashion, only live. And so here's his argument going, look, we're missing out on that many customers potentially because we don't have a warm body in a store. That obviously can impact your NOI and the value of that asset very, very quickly.
So if we take those people out of the store, those customers all have a cell phone. They all have a computer. They all could choose to interact with us that way, but they want to go to the store for a reason. And if they get to the store and there's no one there, maybe they'll scan the QR code. maybe they'll go online, or maybe they'll go across the street to the competitor. And you don't need to lose too many rentals in a high margin business where your expense savings is overshadowed by the loss of revenue. So as long as the customers are telling us they want to talk to a store manager, right? 31% of our tenants walk into the store. 5% of our tenants start online, reserve a unit, but will not sign a lease until they go to the store, see the unit, and talk to the store manager.
So there's 36% that are saying, hey, I want to talk to a warm body. You know, there's a lot of people out there in this industry that are trying to run things completely remotely. And there you got Joe Margolis with probably the most data, in this industry, or at least close to it, suggesting that 36% of their customers absolutely want a human, a warm body that they're going to interact with before they make that final decision to become a customer and a client. So I just think there's some really interesting data points here. Would love to know your point of view, your thoughts on what you hear from Extra Space heading into 2026. Their guidance, public storage guidance, wasn't much better, if at all. And again, we'll break that earnings call down very, very soon. So please share this video with family, friends, colleagues, and definitely put your comments here below and let me know your point of view. Again, this is the Self Storage Report. I'm Chris Berg. We'll see you back here again very, very soon.